Okay, welcome to the Chapter 21, the final chapter in Unit 4 presentation lecture. In Chapter 21, we will be discussing and going over the accounting procedures for publicly held corporations. So let's first take a look at what exactly is a publicly held corporation. So when it comes to Chapter 21, in Section 1, we will be discussing the characteristics of what a corporation is, and then how to record the issuing of stock. Now, up until this point, we have been introduced to the capital stock account, but when it comes to issuing the stock and recording transactions for the issuing of stock, that we haven't done yet. So that is something that we'll be doing here. And then in Section 2, distributing the earnings of the corporation, we will talk about dividends and how dividends is very similar to drawing in the form of a sole proprietorship. So those two are very similar in that regard. And then the financial reporting for publicly held corporations, which is the statement of stockholders' equity, as well as preparing a balance sheet for a publicly held corporation. So let's go ahead and get started here. All right. So publicly held corporation versus a closely held corporation. A closely held corporation is owned by a few persons or a family, and a publicly held corporation is usually through stock issuing. Those become the owners, and it is traded on the New York or American Stock Exchange. All right, so characteristics of a corporation. There's legal permission to operate. There's a separate legal entity away from the owners. The stockholders now, as investors, are the owners. And there's also a professional management or board of directors that make business decisions on different business processes and different business procedures. All right, so as we go through this, make sure that you have the Chapter 21 note guide with you so that you can take the notes down, as well as also the demo problems so that you can attempt the demo problems as we get to those points in the presentation lecture. Otherwise, we will be going over the demo problems in class, as you know. All right, so this account called capital stock. If we break this down a little bit further, authorized capital stock, this is the maximum number of shares that a corporation may issue. This is decided upon by the board of directors. Now, when it comes to stock, this thing called par value, which is basically the value of the amount of stock. This is the dollar amount assigned to each share before it is sold. So if these stocks are issued to be sold to investors, they're going to be sold at $10 a share, $12 a share, whatever the case might be. That is known as the par value. Now, when it comes to stock, there are two main types of stock that a lot of corporations will sell to stockholders: common and preferred. Common stockholders, if you are a common stockholder, you have certain perks to being a common stockholder, and that would be you can elect, you have voting rights to elect the board of directors, you can send a proxy, you can receive dividends, and you could possibly even share of assets if the corporation goes out of business. Now, on top of being a common stockholder, if you are a preferred stockholder, you get additional perks. So you also get to elect board of directors. You also get to send proxies. You also get to receive dividends. However, you will receive your dividends before common stockholders will. And you can also share assets if a corporation goes out of business, and you will do this before common stockholders. So preferred means you're going to reap the benefits of being a stockholder first. Common stock will reap their benefits after the preferred stockholders have reaped some of theirs. Okay, so those are the differences between the two different types of stockholders. And it also could be the two different types of stock that's issued by the corporation. There might be X amount of shares of preferred stock issued, as well as X amount or Y amount of shares of common stock issued. All of that, though, is making up the stock that is issued. It's just going to be categorized differently. All right, so the issuing of common stock at par value. Now we're going to get into the actual accounting and the transacting of these, or recording these as transactions. So on January 3rd, On Your Mark Athletic-Wear issued 10,000 shares of $10 par common stock at $10 per share. On Your Mark received $100,000 for shares. The source document is Memorandum 3. So 10,000 shares at $10 a share, that's $100,000. And in order for us to transact that correctly, we will debit cash in bank. The investors have invested, we now have cash, and we credit an account called common stock, because the common stock is the type of stock shares that were sold in this transaction. Okay, so debit to cash in bank, credit to common stock. Now, what if we are issuing common stock in excess of par, which means it's going to be above the par value? So in this case, investors want to pay more than the stock is valued. It is paid in capital in excess of the par account, which is created. So we're going to use this account in order to keep track of the par value of our stock and how much money we've received based off of par value, and then also how much money we've received based off of in excess of par. So if we're paid in capital in excess of par, this is a normal side balance on the credit side, which means credit's going to increase the account and debit's going to decrease the account. So then the issuing of common stock in excess of par, this is what the transaction is going to look like. Let's first take a look at the clue. On January 5th, On Your Mark issued 5,000 shares at $10 par value. So that's the amount of par value stock that was sold. And this stock was sold at $11.50 per share. So it's a $10 par value, 5,000 shares sold at $11.50 per share, which is $1.50 in excess of par. On Your Mark is going to receive $57,500 for the shares. So this is a compound transaction, first going to record the issuing and the collection of money for the stock that was sold at par value. And that is the $50,000 here, common stock. And then the amount of stock that was sold in excess of par. So that is going to be 5,000 shares at 1.5 per share. That's going to equal 7,500. That is recorded here. And that means that the total cash collected from these stock sales is 57,500. So issuing of common stock at par value and in excess of par would be transacted in this manner, a compound transaction. Okay, let's take a look at issuing of preferred stock. Now on January 4th, On Your Mark issued 250 shares of preferred stock. This is at $6 per share, or I'm sorry, preferred $6 stock, $100 par at $100 per share. So On Your Mark is going to receive $25,000 for the shares. Memorandum number 5 is going to be the source document. So how do we get this? 250 shares, $100 par value, 250 times 100 equals 200 or 25,000. So 25,000 is going to be the amount of debit to cash. That's the amount that we received. And now we have to credit the proper stock account to what we sold. In this case, we sold preferred stock, $25,000. All right, demo problem 21-1 is going to take us through 3 different transactions in the issuing of shares of common stock at par value, the issuing of shares of common stock at par, and also the issuing of preferred stock at the value per share of the preferred stock. So transacting those different transactions would be recorded in this particular problem. Go ahead and attempt that on your own. If you want to give it a try, great. If not, we will be going over this problem together next time we meet in class. All right, so to conclude section 1, these are the questions that you want to think about. Problem 21-1, we'll be doing this in class. So if you can answer those 3 questions, chances are you got a good grasp of what's going on in section 1. All right, let's take a look at dividends. Dividends is what goes back to the owners or the stockholders after business cycle is completed. So this is the distribution of cash to the stockholders. It must have an adequate balance in the retained earnings account. The contra account to stockholders' equity closed into retained earnings. It is a temporary account. Dividends, like I said when we started this, dividends and drawing are very similar in terms of their account properties versus in a sole proprietorship, drawing, and a corporation, dividends. If a corporation has 2 types of stock, they will have 2 dividend accounts. They will have dividends for common stock and dividends for preferred stock. All right, dividends on preferred stock. This is the amount of money that is going to go back to the stockholder. Normally, it's a percentage per share. So dividend is predetermined dollar amount. It doesn't matter how much money the corporation has made. So this is pre-purchased by the stockholder, the dividend agreement. This is how much dividends you're going to be able to collect by being a preferred stockholder, no matter what happened in terms of financials. All right, so on the date of declaration on November 15th, On your mark, Board of Directors declared an annual cash dividend of 250 shares of $6 preferred stock. It is payable to preferred stockholders on November 29th and will be paid on December 15th. So the total preferred dividends is going to be $1,500, which is 250 times the dividend amount of $6. Memorandum 215 is the source document. So we first have to issue the dividend. So we haven't actually paid our owners yet. So now we declared a dividend. So dividends preferred, 1,500. Dividends payable preferred, 1,500, which means we owe this to our owners, but we haven't paid them yet. So the date of record, when the date of record is recorded in the General Journal, this is the checks that it records. It prepares a list of preferred stockholders. There is no journal entry here. Okay, so make sure that we keep that in mind. There is no journal entry in that case. All right, so now we're on the date of payment. So on December 15th, on your mark, issued check 1373, $1,500 in payment of the dividend of preferred stockholders. So in this case, we're going to debit the liability of dividends payable preferred for $1,500 and credit cash in bank $1,500. Checks 1373 is the source document. So this is the paying of the dividends. Let me go back. This is the declaring of the dividends. This is the paying of the dividends. Okay, so make sure that you understand the difference between those two types of transactions and can record them correctly. All right, dividends to common stock. When we have common stock, they could also receive dividends. Let's say, for example, in this example, number one, we have amount per share. 50 cents per share is the dividend. You receive 50% or 50 cents on each share that you own. Total cash, we have preferred stock is paid first. Remember, preferred means that you get preferential treatment. Your perks are going to come first. Remaining amount then is divided equally amongst the common stockholders. So in this example, let's say, for example, we have preferred stock dividend set at $6. Total cash dividend is $3,000. So 250 preferred stockholders are going to get their $6 per share. That is going to equal $1,500, and then of the 15,000 common stockholders, they're only going to get what's left, which is 10 cents per share. But both of them are going to have to be recorded as dividends paid. All right, so let's take a look at this. We will be doing this in problem 21-2, so go ahead and give this a try if you wish. Otherwise, we'll be working on it when we come together next time in class. All right, and then we'll also go through the thinking critically, which is problem 21-2. If you're able to answer those questions with little difficulty, chances are you have a pretty good grasp on the content of section 2. And then there's one more problem, 21-3, which we'll be doing also as independent practice. All right, so the statement of stockholders' equity, which is the financial statement that we're going to record and show these dividends. This is what it looks like. There are 5 columns, one for $100 par value preferred stock, one for $10 value of common stock, paid in excess, if there is any, is recorded here. Retained earnings throughout the course of the accounting period is listed here, and the change in fluctuations in that. And then also, as the math is done going horizontally, the totals. And then as any other document, we would have a single line here indicating calculations and double line indicating calculations are complete. So we'll be getting a chance to practice this in class as well. Problem 21-3 is a demo problem where we will be constructing a statement of stockholders' equity, and we will get our chance to do this together in class. And then finally, the balance sheet. We know what the balance sheet is. That is our financial statement that indicates the equity within the amount of the accounting equation. So assets equals liabilities plus stockholder equity. This is the stockholder equity section of the balance sheet. It gets broken up in this manner. So now we have our preferred stock section, our common stock section, our paid in excess of par section, and then how that impacts retained earnings, stockholders' equity, and how that adds into liabilities to make sure that it equals the assets. Problem 21-4 is a chance to practice putting together a balance sheet, well, actually the stockholder equity portion of the balance sheet. We'll get a chance to do this together in class. And then independent practice problem 21-4 is also an assessment to see that you understand the material that was presented in there. If you can answer these questions with relative ease and little difficulty, chances are you have a pretty good grasp on section 3. And this concludes the presentation lecture for chapter 21. Please make sure that you go back and revisit the slides and get the notes down, attempt the demo problems, and I will see you next time we meet in class.